Hey Joe, Max Boyle here. Sorry it takes so long to get this to you. I've just been crunching numbers every which way I can, and I'm not sure that my numbers are better or worse. They are better in the long term and probably not as good in the short term. Here are my current assumptions I made just from talking to you. Of course, the balance of 230, your interest rate, when it started, the original amount, the approximate payment you indicated, and of course the current balance, interest rate, the original amount, and so forth. And of course we know that Chase will refi the first only up here at 5 1/8% interest. And so what I did was I simply went over then to my loan origination software and started doing the equivalent of a good faith estimate. And what I did then to get the loan amount was to do the payoffs for the first and the second, which is the principal balance of each plus 30 days worth of interest, because you're always paid behind in your interest rate. So your payoffs will be higher than what your current balances are. And so over here you have fees, and I'm going to show you a credit against those fees. But this is an FHA 30-year fixed with no prepayment penalty, of course, at 4 7/8 on the interest rate. And we'll have the 1% origination fee, processing, underwriting, that sort of thing. The appraisal fee, $350. We'll talk about the appraisal in a minute, of course. Credit report. With FHA, you do have to pay mortgage insurance in two different ways. You have to pay upfront, which is $29.24, and added to the loan amount, and that's how we get our total loan up here of $295. And there's the closing fee to the title insurance company, the title insurance, and of course Chase is probably doing this without any title insurance since they already hold the loans. But when you do a new loan, you have to do that. I've already also got escrows here. I put in 14 months worth of taxes. Basically, it's not going to be that much. I'm going to guess about 11, because now that your 2010 taxes are due, first half is going to have to be paid right here in February anyway. So, but then what I did was at this interest rate here, we give you a credit back of $5,900 towards your closing costs. If we look at the bottom part of this sheet, it will sort of show what we're doing here in terms of debits and credits, and I've tried to zero out your cash to closing. And so, because I don't know exactly what Chase is willing to do for you in that regard, I know you said no closing costs. I don't know, and they'll just transfer the escrow accounts over to you. That's certainly an advantage from a cash flow standpoint. With us, what you're going to have to do is bring in those escrows, as I had shown you up above, and then after closing, they will refund back to you whatever escrows they have in their escrow account. So what we charge you up front should be pretty much offset by whatever they're going to refund back to you at closing. So you have to pay for them at closing and then get refunded 30 days later. That's the disadvantage of going with me and the advantage of going with Chase, I suppose. But what I've tried to do is to show the principal and interest here. Homeowners insurance, I'm not sure if this is right or not. That's kind of a guesstimate. Taxes, I do know because I looked them up. And then the mortgage insurance premium, which, by the way, is a tax deduction for you, just like interest is, for a total payment there. So what I've done then also is to prepare this report, which simply shows your current loan with the payoffs here. The weighted average interest rate of your first and your second combined is about 6.4% because of the high interest rate on that second mortgage that you have. And the payments here should be about this. On a 30-year fixed at 4 7/8, of course, your payment will be here. Savings is only $75 a month. And so you can see over 5 years that the non-recoverable costs, if you will, are just about a break-even point. It's still a minus $728. But if you look at the interest and the mortgage insurance paid over a 10-year period, it's a lot different. With the new mortgage, you would be saving the difference there is about $18,000 or so over a 10-year period. In that sense, in the long term, like I say, it starts to make definitely a whole lot more sense. So you may have questions about this. Give me a call. It looks to me like that in the short term, probably refinancing with Chase would be better, but in the long term, refinancing with me is going to be better. And so you have to decide how long you're going to be in the house. And since homes are not appreciating in value, and probably won't for quite a while, I would guess you'll be in there for 10 years or so. And also the other thing is that I'm predicating this upon a $300,000 appraised value, and it's going to be pretty close, I believe, and that's one of the risks we're going to have to take, or you're going to have to take rather, if you proceed with this. Because what I would probably do first is go ahead and spend that $350 for the appraisal and see how that comes back. Obviously, if it doesn't come back at $350, then we're not going to be able to do this with you bringing no money to closing. So give me a call, office 303-600-8248, and cell phone 303-828-6621. Talk to you soon.